Welcome to TheoTrade. My name is Don Kaufman. Let's talk a little bit about volatility futures. Oh yeah, the volatility futures, they're what's in. They're kind of like the in and vogue product right now, rather than looking necessarily at the VIX. But if you're not familiar with number one, futures contracts, and number two, volatility futures, okay, I'm not here to tell you that you need to trade volatility futures. Not at all. Quite contrary. I am here, though, to tell you you need to start looking at volatility futures, because without it, you're blind. Okay? And the volatility futures, they relate to like every single product on your screen, because what moves volatility futures? Order flow. Okay? And order flow is just trades coming in. And the order flow, okay, and the sensitivity of the order flow can really be felt by looking at these volatility futures, and you're like, I'm not necessarily sure where you're going with this. Okay, back up a little bit. The volatility futures are listed, okay, for numerous expirations. Here we're looking at the active contract, and again, you can see the volatility futures are up almost 50 cents. The VIX only up about 23 cents. The market's actually getting whacked pretty good right now too. Great time to talk about the vol futures. But we're only looking at the active contract. The active contract, this is the one, okay, quote unquote, that most people trade. Most are trading the active contract. But there's a lot more than meets the eye. So what we want to do is here on Thinkorswim, go from active only and open up all. Now, one thing that is kind of confusing when you look at the vol futures, they now have these volatility futures weeklies contracts. There's very, very light volumes, like 30 contracts traded here, 21 here, 13 here on a pretty extreme day, right? So what you want to do is you want to look for the monthly contracts, the ones that, quote unquote, again, really trade. And when you start to read into the volatility futures, there's a 34-day volatility future, a 62-day volatility future. We can go even further out, 90-day volatility future. And what you're getting a read on is what the market is interpreting risk in the next 34 days, what the market is interpreting risk, for instance, 62 days out. And you can start to look at, okay, volatility futures with 34 days remaining versus volatility futures with 62 days remaining. You're like, why do I care? Okay. Number one, the volatility futures, this is a real, tangible, tradable product. Okay. So why does that matter? Why should that matter to you? It's because so many people look at the VIX. The VIX isn't even a tradable product. The VIX is a calculation based on SPX, okay, implied vol. This is a real product. Like, people are buying and selling it. So again, if you want to get that like real feel of market conditions right now, you got to be looking at the vol futures. I'm telling you, like, the VIX has become kind of my predecessors. I mean, that's what they were into. All right. So, there's again, I've been trading now for 18 years, and a couple of guys that I kind of came up through the ranks trading with, and they've been trading now 40 years, and they used to talk about the VIX, like 20 years ago when I got involved in this business, like, kid, you got to look at the VIX. And now I'm turning around and saying, well, kid, you got to look at the vol futures, because if you don't, you're dead. All right. And that's the reality, is this product wasn't around, umpteen years ago. And when I say it's the end product, it's the fastest way to feel what risk is in the marketplace. If they're buying volatility, duck and cover, put your helmet on. If they're selling volatility, we're likely to rally. But the vol futures are going to give you, again, a much clearer interpretation. Then, when you really start to get into this, you can start to learn to look at vol futures from one expiration to the next expiration. And you can actually judge, all right, what the market is saying about risk. Sometimes January volatility will literally eclipse February volatility. Like, think about that, what that really means. Like, 62 days out. Does 62 days from now hold more risk than the next 34 days? I mean, my answer, like most of the time, like, yeah, of course. Like, why should 62 days have more risk than 34 days? I don't know. Given the fact that there's double the time, listen, the world could fall apart in 62 days. But in the next 34 days, it could fall apart, okay? But it probably can't fall apart as much as it could in the next 62 days. Given the double amount of time, there's going to be substantially more risk. Yeah? Well, look what the marketplace is telling you right now. So I'm going to freeze the screen because this is important stuff. You know what the marketplace is telling you right now? It's going to zero in right on here. Okay, the marketplace right here, right now, is actually displaying risk in January almost as high as risk in February. Why is that important? Because it's kind of saying the market could come apart at the seams right now. Okay, but 62 days from now, it's not showing much more risk than it is right here, right now. That means, okay, risk is here, risk is prevalent. And from time to time, you won't even see this thing at 1865. You'll actually, once in a while, you'll see something like it at 22, and then February will be at 19. What that says, risk is on, like we're getting crushed in markets, and they're actually indicating that the risk in 34 days is, in fact, greater than risk 62 days out. Now, that is an unusual circumstance, but that's your signal of like, put the helmet on, tighten the chin strap, we're going in, you know, and that's the way you need to read volatility futures. Last, but definitely not least, in understanding volatility, the VIX. Why do I bring up the VIX? Because these options on the VIX, have nothing to do with this number, this last traded price. The options on the VIX are actually priced off of the volatility futures. Now, somebody's head just cracked open like a cantaloupe, okay? But check this out. So we're going to open up a few more strikes in here. Let's open up like 20 strikes. And I want you to realize, like, we're going to look 26 days out. All right, those are weeklies. Let's just go to like one of the standard expirations. We'll even go as far as 61 days out. Okay, we'll go 61 days out. Look at the 12 calls. Now, the 12 calls, okay, according to this, they're in the money by what? Well, the VIX is trading at 18. The 12 calls are what? Okay, they're about $6 deep in the money. But I'm telling you, these 12 calls, they're not even based off of this number. Okay, they're based off of the volatility futures that are 61 days out. I'm going to show you that momentarily. So if this is right, if these options are deep in the money, the volatility futures that are out there should basically be what? The 12 calls are indicating, because they're deep in the money, that this product is trading in and around what? 12 plus about $7.10, which is a mid price. Okay, and I know this stuff's a little esoteric, but that would give us a price of about $19.10. All right, so if I look at the volatility futures and I scroll, okay, and I go some 60, days out, it's a miracle they're trading for $19.10. Now, how did I know that? Because again, the VIX options are actually based off of what? Off of this little guy right here. Okay, and you could do this in the weeklies as well, but let's even go 90 days out. Let's get crazy. All right, so here's the March. The March says what? 1934. Well, if this is true, then I should be able to go to the VIX, and I should be able to go to the options that are about 90 days out. Okay? And the options that are 90 days out, and I'll go deep in the money. And I'll look at the 10s. And what are the 10s telling me? The 10s are actually telling me the market is $9.10, $9.40, which pretty much gives you a mid price right around what? $19 and about 30 cents. $19.25. The market's live right now. It's moving around on me. Okay. So again, understanding these volatility futures, this is what people are trading right now. All right. This is what people are trading. This is the here. This is the now. Okay. I also want to recognize the volatility futures are only up some 37 cents with the market down $21. That, ladies and gentlemen, is unusual. So I say that because it's unusual to see the market down as much as it is. With the volatility futures, they're barely moving. Maybe that's telling us something about what risk is going to be, all right, on this fateful day that I'm recording here about the volatility futures. I want to thank everybody for joining us here at TheoTrade. Again, my name is Don Kaufman. We will be back with much more education about volatility futures, about understanding probability. You name it, we're going to have classes on it, free classes on it, all kinds of stuff in our chat room on it. That's what we're here for. Thanks a lot, everybody.